Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Tom, welcome back to the podcast, mate.
Thanks, Owen. Great to be back on with you.
It's always good to chat, mate. It's always good to chat. You know the drill. I like to start with a few icebreakers just to get us in the swing of things. We're going to be talking about ETFs. Primarily, we're going to talk about Aussie shares, and we're going to talk about smart beta, what that is. Mm-hmm. We're going to talk about quality investing, what that is. But first questions first, what's been your best investment?
So my best investments, my highest returning investment, I'm not sure if shamefully is the right word, but it was a cryptocurrency. I got in on the hype from an office recommendation. It was Sandcoin, which is the official coin of Sandpit, one of the metaverses, and it went 10x. But I'd consider that more a trade than an investment, right? That wasn't an investment. That was just a trade for money. So my best actual investment, mine the early plug, but it's actually Betashares NASDAQ 100 ETF. Bought it a number of years ago, and it's up, I think, close to, if not over 100% since then. And I plan to hold it for a very long time. So I'd consider that one a proper investment, yeah.
Yeah, fair enough. And, sometimes we get lucky. I did not expect you to say that, though, so that's interesting. Okay, another short answer question, a bit of an icebreaker. If you had to pick between the Betashares Australia 200 ETFs, that's A200 is the ticker symbol. This is the, index fund of Australia, and an investment in gold. And you could take that, I know, through the suite of funds you have is the Betashares Currency Hedge Gold ETF. I think it's called Physically Backed. Yeah. QAU is a ticker symbol. Now, I'm asking you to do this over 10 years because we're not here. One, we're not looking for recommendations. It's just a bit of fun. But two, we're long-term investors. But I'm curious which you would choose, the Australian shares or gold?
Yeah, it's a very topical question at the moment. I mean, gold has a lot of interest at the moment. It had really strong returns the past 12 or so months. And strong returns, like, contrary to its typical drivers. So it looks like a lot's going for it, and we're about to have potentially a bit of US dollar weakness, real yields coming down. So that's all really positive for gold. But I'm still going to go with A200. The main reason being with gold, it's not an income-producing asset, so you really have to get that price call right, which is difficult. With the A200, they are older, more mature companies, but they are, typically giving you 4 to 5% franked dividend yields. You reinvest that over the 10 years, you've got a pretty strong basis for positive returns. So I'm going to go the Aussie market. That's
a good answer, actually. I like how you talked about the yield that you get, you can reinvest and it can keep compounding. That's a good one, mate. So final short answer, or icebreaker, is which financial book or podcast has left the biggest impression on the way you think about, I've got good investing here. So just the way that you think about investing.
Yeah, so for me, it might not be the most informative book I've read or the most deep in the markets, but the one that I think that has stuck with me has been Rich Dad, Poor Dad. And I think it's more because of when I read it. My dad gave me that book when I was maybe 11 or 12 years old, and he asked me to read it. And I just think because of the timing of when I read that book, and I hadn't really thought about financial markets or money too much at that stage. And it really made me from that point forward just have these ideas in my head and from a younger age think about investing and spending your money versus how to make it work for you. So that's the one I'd have to go with.
Yeah, cool. I like it. There's some irony, I'm sure, about a dad giving you a book called Rich Dad, Poor Dad, but I haven't thought about it yet. I don't know what it is. So we're going to be talking about ETFs. Now, I don't want to leave anyone behind. So just in case, we know that thanks to some research that I believe Betashares and Investment Trends have done, there's over 2 million people have bought ETFs in Australia, exchange-traded funds. I don't want to leave anyone behind for the rest of this conversation. So I'm just going to set the scene and use an example that we've used previously in a mini-series that we've done on ETF investing, and basically remind people that an ETF is kind of the wrapper or the box of favorites chocolates. And what goes in is a bunch of all different stuff. And I think the favorites line, I don't know if they'd like me saying this, but I think it's like you take it when you don't know what to take or when you're asked not to take anything or something like this. But the idea is you buy the box and inside you get a bit of BHP, a bit of CBA, a bit of Woolworths, a bit of Telstra, and it's all in that box. Different flavors, which is important because we'll talk about how you can kind of focus on just a few of those flavors throughout this podcast. And when we get that box, that's an exchange traded fund. The benefit is that you get the box, not individual cherry ripes or picnics or whatever it is that you don't know if people will like. So I like to think of this as A200, which is the ETF that we mentioned at the top of the show. It's just like a broad-based, kind of captures every type of chocolate in it on the Australian market. Now, first of all, does that analogy make sense to you?
It does make sense. I think my favorite part of the analogy is you have to remember an ETF is just the wrap, is almost like the boxes you put the wrapper, right? You can put anything in the wrapper, because some people get confused and think, an ETF has to be a broad market passive fund, or they're synonymous with that. It's not true. You can have active ETFs, passive ETFs, smart beta ETFs, which we'll talk about today. So it's just that investment vehicle. And to your example, with an A200 ETF, that vehicle's filled with stocks of Australian companies chosen by an index. So from that standpoint, I do like the analogy.
Okay, thanks, man. So this idea is that you could have all different types of stuff in that box. It may not even be chocolate, as in it may not even be shares. It could be like the AAA ETF from Betashares is like one of the most popular, which is just cash inside it. And you could have bonds in there. You could have property securities, all different types of stuff. Hence the power of ETFs. One of the things that we talk about also, not to take the flavor analogy too far, is this idea of a vanilla strategy being like an index fund. An index fund in a traditional sense is like broad-based, low cost typically, but it follows something called an index methodology. Maybe I'll ask you to explain this when I ask you, why do you think traditional index funds and index ETFs do so well, Tom?
I think there are a few reasons. The first reason is, the growth of ETFs has been somewhat synonymous with the growth of passive index investing. Before ETFs, there were funds available to invest in the index. It just so happened that the popularity of using those funds also coincided with ETFs, launching. The first ETF launched in Canada in 1990. In Australia, it was in 2001. And this concept of index investing was somewhat new to investors at that time. So they've definitely grown together, which has helped. But also, I would say it's intuitive index investing. Like when we quote how a stock market has gone, in Australia, we'd quote the S&P ASX 200. In America, we might quote the S&P 500. And those are both, as you put it, vanilla broad market indices. And those indices, simply with their methodology, will pick the largest stocks listed on a stock exchange. So it's intuitive for investors. It's how we think about returns of different markets. So those are two reasons. Another reason is despite their simplicity, they're fairly hard to outperform. A lot of active managers benchmark themselves to these indices, and we know that it can be really hard to outperform them over a long period of time. So those are a few reasons. I'd also say, why are they hard to outperform? Where's this great performance coming from? And it comes back to their intuitive nature, whereby with a passive index ETF, as a company grows, as it's more successful, it typically grows in size, which means it'll grow in weight in the portfolio. And so you're buying more of the winners and you're selling more of the losers, really. And so that's that in itself has been really good for, I guess, performance of markets over time, and good for that intuitive nature of index investing.
I liked that that second one that you gave in particular, which was that because they're what we call market cap weighted, meaning the bigger ones get a bigger share of the portfolio. What we're effectively saying there is it's almost like by not selling them, we're supporting them to keep growing and growing and growing, and we're benefiting from that. And then the ones that were big but don't keep growing will slowly just trickle away. And that's a really neat way to put it. The one thing that naturally falls from the idea of the box of favorites analogy is like, well, what happens if you just wanted dark chocolate, or what happens if you just wanted vanilla, or you just want like a particular thing, like only fruit flavored chocolates to go in that box? And this is where we start to get into the different ways that we can introduce something called factors. And these are like different things that identify companies, in this case, that we are looking, the attributes that we're looking to get our exposure to. So maybe it's just, the dividend stocks, or just the companies that have grown fast, or whatever. And we're going to talk a bit about that. But a concept, Tom, that people, maybe some of our advanced or intermediate listeners would be familiar with, this concept of quote unquote smart beta. Can you explain what that is and how it may be different to what we've been talking about so far, which is that traditional index fund or market cap weighted strategy?
Yeah, of course. I mean, starting with those traditional funds or traditional indices, that's what we would describe as market beta, really. Market beta being the performance of the broader market. So for investors, always, there is a benefit to just, tracking market beta at low cost and being diversified. But, it's fairly intuitive to want to seek alpha, to want to seek, I guess, outperformance over market beta. And one of the ways it's becoming more and more common to do so is through this concept of smarter beta. You're still tracking a passive index. So it's still index investing. You're still following a set of rules that defines what companies you'll select. But with the smart beta index, instead of using size, so your traditional broad market, vanilla box of chocolates, uses size or market capitalization to select the companies and to weight them. Really, any index that selects and weight companies using a different set of rules would be considered a smart beta index. So, for example, and something a lot of investors may be familiar with is quality investing. What does that actually mean? Well, we're seeking to invest in companies that have high quality characteristics. Typically, they're fairly profitable. They've got sustainable earnings that are recurring year on year. They've got low levels of leverage. So a smart beta index might take those characteristics and say, okay, we're only going to select companies that meet that criteria. Likewise, you can have value indices that look at companies with, low book to value ratios that have high dividend payouts. And it'll say, okay, we'll just select companies with those attributes. And by doing so, different factors typically outperform at different parts of the market cycle. So investors might want to use different factors to try and outperform the market, try and generate alpha at different phases of the market cycle.
So, for example, this follows into my next question, which was, why would investors choose like a smart indexing strategy over the traditional, one? And you mentioned there that it maybe performs at different periods. Like one of the things with like A200 is it owns like the big banks. And if you have a view on that, maybe you think maybe there's a way to kind of change that mix in my portfolio, or maybe resources, iron ore, gold, copper. Maybe you think prices for those commodities aren't going to hold up as well. So maybe I want to change that. Is that the key, in your opinion, is that the key reason to start blending these things in?
It's part of the reason, yeah. So if we think about how investors typically, to your question, why or how investors use smart beta in practice. A good example, I might even just find what you said there. A good example, so with a smart beta index, it doesn't need to be a factor exposure even. It can be, even something as simple as equal weighting. So an equal weighted exposure, let's use the US market as an example. You've got the S&P 500, the 500 largest companies in America. Right now, the top 5 companies in that index, your Apples and Microsofts of the world, since they've gotten so big, they make up around 25% of the S&P 500. The bottom 400 companies in the S&P 500 also make up 25%. So to your point, you use the Australian market as an example. I've used the US market, but in that sense, you're fairly concentrated in a few number of names. So something as simple as an equal weight index, where you take the same 500 companies, but you allocate them 0.2% each on each rebalance. It gives you much better diversification. So to your point, investors might use that to help improve diversification, help have less concentration in those names. But also, on top of that, if we go back to the factor examples, again, those names in the Australian market, you mentioned the large banks and the large resource companies. We wouldn't typically classify those as high quality companies. And over the past 10 or so years, quality as a factor has been a really strong performer. Investor might say, okay, I'm a bit more of looking for a bit more of capital growth here from my Australian equities. What can I do? I've already held the A200. Okay, maybe I can hold a quality index as well to try and, move towards companies with high propensity for growth. The same can be done for, higher yield companies or value companies. And then, you can use these funds individually. So just to have a high quality core portfolio. Or if you get a bit more sophisticated, you can start blending these factors as well. These factors tend to perform well at different parts of the cycle. So by blending them, again, you can try and enhance returns. And ultimately, I guess the bottom line is, a smart beta index aims to enhance the risk-adjusted returns of a portfolio. So be it, improved total return, be it reduced volatility, or a combination of the two. That's, I guess, our ultimate goal when using smart beta funds.
Yeah, because this is one of the things we're going to talk about is the AQLT ETF, the Betashares Australian Quality ETF. And this is just in the lead up to today and doing some prep. I was just looking at many of the companies that I would think of in Australia as really high quality. This isn't an exhaustive list, but companies like WiseTech Global, which is the logistics software business, Pro-Medicus, which is a health technology company. In full disclosure, I own some shares in that. ResMed, which is another health technology company, Cochlear, which people would be familiar with, the acoustic or hearing implants and that sort of stuff. Other companies would be like Wesfarmers, owner of Bunnings, and the list goes on and on and on. And what I realized is a lot of these high quality companies have done really, really well. And that might just be because they're good companies, but maybe there's something else going on in the investor landscape right now. So I'm curious of all the different types of factors that you look at, like which are the most popular or gaining popularity?
At the moment, you've hit the nail on the head. The most popular for a number of years now has been quality. A lot of it comes down to performance. Over the past 5 to 10 years, quality as a factor has performed really well, particularly globally. You look at some of the largest companies in the world, your Apples, your Microsofts, your Amazons, those all classify as high quality companies. And we know how well they've done in recent times. But it extends beyond, the US, as you've mentioned, those Australian names. Those are some of the highest quality companies in Australia, and they've performed really well as well. So definitely quality. A few others I'll mention though. Size is a factor. Size as a factor has been quite interesting. Over the past 2 or 3 years, we've really seen large cap companies, or mega cap companies, so large size companies drive out performance globally. Again, quite attributable to those large US names. But at the moment, we're seeing a bit of a shift towards people looking towards relatively smaller size companies. Some of the thinking here is, the rise in interest rates hurt those mid and small cap companies more. We know this through their balance sheets. We know this through the consumer. So the thinking is maybe it's time for a bit of a rotation from large to small caps. So that's one way we think about different factor and size rotations. I guess another one that's always of interest in Australia is high yield. As Australian investors, we love income, and so high yield is a factor amongst Australian companies is always a fairly popular one. But I come back to quality as one that we see as the most popular at the moment, and probably has a lot of room for popularity going forward, both internationally and here in Australia.
Yeah, it's interesting because people are probably now starting to, through those examples that you just gave, truly grasp what we mean by smart beta or even factors is, size. You mentioned in a lot of literature, which you and I have read, but maybe other people haven't read, it suggests that smaller companies tend to grow faster than bigger companies and do better. But you just said that maybe there was bigger companies like all the names you mentioned before, and some of those in Australia, like the Telstras, the Woolworths, that have been really resilient during times of uncertainty because people kind of go to them. But maybe now we see that shift back the other way. Now, this ETF that you're about to talk about is the AQLT ticker symbol, Betashares Australian Quality ETF. I think this will illustrate the example really well. Can you tell us how this ETF constructs its portfolio, like how it's different to a traditional, even if you don't have to compare it to A200, but just how it compares to like a broader index style ETF, traditional index style?
Yeah, definitely. AQLT it's actually even more nuanced than some other quality indices. And I'll get into that, but just simply with AQLT, the aim is to hold, a core portfolio of Australian companies with high exposure to the quality factor. And so the way it does this, half of its portfolio is made up of, the highest quality companies in the ASX 200. Some of those names you mentioned earlier, like WiseTech and ResMed, some platforms like even NetWealth and Hub24, they qualify for the index. Why? Because they have some of the highest return on equity out of Australian companies. They have low levels of leverage or low debt to equity ratios, and they've had fairly consistent earnings over the past 5 years. And those are three of the key metrics you'll typically use to select high quality companies. Now for the slightly nuanced part, if you take a standard quality index, like the ones we apply globally, and you apply it to the Australian market, you'd stop there. You'd say, okay, give me the highest companies for ROE, for low debt to equity, for earning stability, and that's my entire portfolio. Part of the issue there is, because of the make of our market, you end up with quite a significant skew to the small size factor as well. So, okay, you've got high quality factor exposure, but now you've also got quite a lot of exposure to the size factor. And what that means is when you watch the returns of that portfolio, a standard quality index portfolio in Australia, the performance of size is going to impact your performance just as much as the performance of quality.
Right.
So to try and overcome this within AQLT's portfolio, what we've done, we actually still hold an allocation to a lot of Australia's large caps. So that some of the bigger banks, some of the resource companies, and we reweight those companies by their quality score as well. So although they wouldn't make it on an absolute quality score basis, we still include them, we reweight them, and what this does, it gives us a portfolio with high exposure to the quality factor, and the other factor exposures in the portfolio are quite similar to the rest of the Australian market, to A200. And this isolates the quality factor in the Australian market, and has proved a really great success for the ETF and for investors looking to access quality as a factor in Australia, because it's actually the first quality factor fund in the world that focuses on Australian equities. And really for that reason, because before we took this more thoughtful approach, it didn't really work in Australia, a passive approach to quality investing.
It's really interesting. I didn't understand the genesis of the strategy and why it was necessarily constructed that way. I should just fill people in for people that are wondering, like, why wouldn't everyone just invest in quality companies? And one of the reasons is, one, they can be hard to find, but two is oftentimes the valuations can go up and down, and you sometimes have to pay for that. So sometimes it makes sense to focus on low value, like good value stocks, and sometimes it makes sense to have quality stocks and small and large, as Tom was saying. Now, there were three factors that you mentioned before: return on equity. So that would kind of be like the profitability of the company, as it's kind of like its economics, as I might say. The leverage, which is really important. Like, I think when people think of high quality companies, they think of companies that have good, strong balance sheets. Another thing is earning stability, which, as far as I'm aware, Tom, maybe you can expand on this, is basically a company's, consistent profitability through time. Have I got that right?
Yeah, it's exactly right, because you don't want to capture companies that have had a boom in 1 year for some reason, but that could be reversed the year after. You want to avoid that. You want companies that are displaying these, strong, because you've already got this. You've already said, okay, this company has strong earnings in that year, but you want to make sure that's been fairly consistent over time, just to make sure it's not a one-off or an accounting discrepancy even can slip in if you don't have rules like that.
Yeah, and I think that's really important, because particularly in Australia, you can end up with, if you just go from like 1 year's financial results, you probably end up with, at the top of the mining cycle, a lot of companies that have done really well from selling iron ore or copper or coal or whatever, super profits. But then the next year when commodity prices fall, then you're still stuck holding those companies as they fall really fast because commodity prices have fallen. So you end up with those kind of quality traps almost. I've got a few more questions for you. One of them is, when most people think of what a quality company is, like, I look around, I've got an iPhone on the table, I don't think anyone in our office is brave enough to have a Microsoft, but maybe they do. But we think of these types of companies. It's not that often that people think an Australian company is the first name that comes to their mind. Do you think that's a myth? And if not, or do you have other myths that people might have about quality companies here?
Yeah, actually, this almost comes back to how we were talking at the start about those passive broad market indices. Since those broad market indices just capture the largest companies, that's how we typically define a market. So for Australia, our largest companies, as we touched on, those banks, those resource companies, which aren't high quality, people then go and paint the whole Aussie market as, it's low quality, it's mature, it's cyclical. Well, yes, if you use that market cap approach, you're going to end up with a portfolio that is a bit more mature, that is a bit more cyclical and lower quality. But it doesn't mean you can't pick out those high quality companies from a market. I guess that's important too, just for investors in general, when they're thinking about using, broad market indices. We paint them with the same brush, like the Australian broad market index, the S&P broad market index, but they're indiscriminate. There's no guarantee that you'll have a mix of the same factor exposure. Like the US market is high quality, high growth, where higher value, higher cyclical. But it doesn't mean, I guess, coming to the point that under the surface there isn't certain companies with attributes across all markets. And Australia's got a really, really strong cohort of mid and small cap companies that do meet that high quality mantra. Some that a lot that we've already touched on, like the software providers like WiseTech. You've got some really good health IT companies, and they're really strong, consistent earnings, low levels of leverage. So yeah, it is a bit of a myth in my eyes.
So it's kind of like you're saying, like people will instantly be like, yeah, but the US is Apple and blah 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 blah, and that's why I invest there. And you're saying, correct me if I'm wrong, is effectively, yeah, but that's because you're just focusing on the traditional way of focusing on a market. You could just target all the quality companies if that's what you wanted. Is that effectively what you're saying?
Yeah, exactly right. Exactly. The same as like in Australia, so about 2% of the ASX 200 is made up of technology companies. But you can buy an Australian technology ETF, which means you can get really good exposure across those companies. And, technology, the booming technology sector in Australia, same for quality. Yes, if you've historically used that broad market beta exposure A200, your portfolio will be tilted towards more mature companies, but using something like AQLT can give you really good exposure to higher quality companies within the Australian market. And the same goes for your global investments. Maybe you're a bit too skewed to mega caps and high growth companies in the broad market indices there. So you can look for actually high yield global indices, or you can look for value orientated global indices, depending on what you're trying to achieve with your portfolio outcomes.
Yeah. Okay. I'm going to include, I've got it here in front of me. I'm going to include a list, a reference to all of the landing pages and different literature that you have, because you do have a fact sheet which kind of goes through and a bit of a white paper. It's pretty easy to read, to be honest. For all financial white papers, it's pretty easy to read. But it's got like all the different, obviously it's an ETF, so it's fully transparent. It's got all the different companies. And people can go and find some articles and these types of things about AQLT. So that's available in the YouTube description or podcast player, depending on where you're listening. And that will take you to the Betashares website, where you can explore not just AQLT, but all of the different ranges of ETFs and different sectors, different products, different services that Betashares provides. Mate, I've got one final this is a tongue-in-cheek question. It's more of a bold prediction. I think I asked you something similar to this last time you appeared. But if you could pick one sector of the Australian market to be rivaling the Aussie banks, so the big banks that we know, or maybe even bigger than them in 20 years from now, what would it be?
It would have to be healthcare, I'd say. We've already touched on a few of the more tech-related healthcare companies in Australia already, like ResMed. I think you mentioned Pro Medicus earlier. So there's already a pretty strong sector there. We've got CSL, which is already a really large global healthcare company. It's just I think it's one of the fastest growing sectors in Australia, in the Australian market. And there's obviously really strong structural tailwinds. We've got an aging population, not just here, but globally. And I think, with our high levels of, education and technology, we could, really set ourselves as a global standard for healthcare and healthcare technology in particular. And as that industry grows, who knows, maybe that could overtake the stalwart banks.
It's really interesting because I think about that's really interesting that you say that, because we do have so many great companies like Cochlear and these businesses and ResMed you mentioned. But even I'm surprised at how big ResMed and WiseTech being logistics software, how big these businesses are now. And it seemed like only 10 years ago they were considered small caps, and they were really, risky companies and whatever, could never be considered that big. But they have risen the ranks and they're still growing. So it's really interesting. I'm really glad that we went a bit deeper and popped the hood on what is ETF investing at a deeper level, go beyond just traditional index ETFs and the market cap weighted indices, mate. There's heaps of literature on the Betashares website. So once again, there'll be a link in the show notes to anyone who is interested. And if you have any questions and you're watching or listening to this, if you have any questions about AQLT or any of these ETFs that we mentioned, let us know. We can bundle them all up in some Q&A sessions and have Tom come back on the program. So, mate, this has been great. Thank you for being our field guide into factor investing, smart beta investing, and AQLT specifically.
Awesome. Thanks, Owen. Yeah, it's one of the faster growing areas for ETFs in Australia, these smart beta ETFs. So it's awesome to be able to educate the listener base on them. But always a pleasure.
Thanks, mate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.